Benjamin Franklin once said there are only two certainties in life: death and taxes. While there is not much we can do to help you with the first one, we can certainly advise you to take some prudent actions to reduce the blow of the other one, taxes. Today I'm here to talk about how to save towards your future and how to maximize your savings on taxes. We are all looking for ways to keep money in our own pockets. Saving tax dollars each year by reducing your taxable income as much as possible can help do just that. So how can we do this legally and save for your future? In this video, I will describe 3 ways to save on your tax returns. Let's start by talking about employer-sponsored retirement plan contributions. One of the biggest and best ways to save on your taxes for employed individuals is to participate in the employer's retirement plan. There are advantages of investing into a 401k, 403b, or a 457 retirement plan. So let's talk about them. The first thing you need to know is that your entire contribution reduces your taxable income, so it saves you tax dollars. Another key piece of information is that the contribution and earnings grow tax-free. This saves you on paying capital gains tax. Automatic withdrawals from your paycheck will help put money into your retirement bucket. And many employers make a percentage matching contribution to your retirement accounts. It's free money. There are some disadvantages to be aware of. Investment choices in these types of accounts are limited. There is a penalty and tax on any withdrawal before age 59.5 imposed by the IRS. However, rollover options are available should you change jobs. Income taxes are paid on any withdrawal you make upon retirement. Finally, you must begin making a mandatory withdrawal at age 72. The 2021 contribution limits for the plans are up to $19,500 for individuals under the age of 50 and $26,000 for individuals over the age of 50. If your employer did not offer a retirement plan or you did not participate in one, you can still contribute to a traditional IRA account. This saves taxes if your earned income is greater than your contributions. Similar to company retirement plans, traditional IRA contributions have their advantages as well. Let's review. In most cases, if you qualify, the entire amount of the contribution is deductible from your taxable income, saving you tax dollars. The traditional IRA offers tax-free growth on contributions and earnings, which also saves you on capital gains tax. There are many investment choices available in an IRA and should be customized based on your investment style, risk tolerance, and personal financial goals. There are some disadvantages you should be aware of. The IRS will impose an early withdrawal penalty and taxes for withdrawals made before age 59.5. There are some exceptions to this rule, but this only applies towards the penalty. Income taxes will be paid on any withdrawal you make in retirement, and you must begin taking a mandatory withdrawal at age 72. This year, the contribution limits for a traditional IRA account are up to $6,000 for individuals under the age of 50, $7,000 for individuals over the age of 50. Keep in mind, these contributions can be made until the tax deadline, April 15th, and will be counted towards the previous year's tax return. Another savings option is an H.S.A, also referred to as a health savings account. If you are enrolled in a high-deductible insurance plan, then you are qualified to save money in an H.S.A. Think of this as a personal savings account, but it can only be used for qualified medical expenses. The good news from a tax point of view is that contributions made to an H.S.A are deductible on your federal tax returns and is also deductible on most state tax returns too. Contributing to an H.S.A account has its advantages. Contributions and earnings can grow tax-free in an H.S.A investment account. Qualified withdrawals are tax-free, and the account can be transferred to a spouse upon death without any tax consequences. The funds in an H.S.A can be used for medical expenses, long-term care premiums, and nursing home care, all tax-free. Contributions can be made until the tax deadline of April 15th for the previous year. There are a couple of downsides to an H.S.A. Withdrawals from this account are very restrictive, and can only be used for qualified medical expenses. Otherwise, taxes and penalties are imposed by the IRS. Transfers upon death to a non-spouse have major tax consequences. The IRS sets the maximum contribution limit every year for these accounts. This year, the limit is $3,600 for individuals, $7,200 for families, and there is a $1,000 catch-up contribution for anyone over the age of 55. These contributions can be made until the tax deadline, April 15th, and will be counted towards the previous year's tax return if you were in a high-deductible insurance plan in 2020. January is a great time to review all of your contributions for 2021. Make necessary changes to save money and pay less tax. Stay tuned for our next video designed for the business owner. We will discuss several strategies which can save you tax dollars and help you reach your own retirement goals. Here at Parks Capital, our hope is that this information will be helpful to you as you plan for the previous and current tax year. Please do not hesitate to reach out to us with questions regarding any of this information we've shared. Thank you for watching.